Warren Buffett spent years sitting on a cash pile so large that financial commentators ran out of ways to criticize it. By late 2024, Berkshire Hathaway was holding roughly $167 billion in cash and short term treasuries. Not invested, not deployed, just waiting. And the finance world was nearly unanimous. It was a mistake. Too cautious, too much drag, leaving too much on the table. So why would the most successful long-term investor in history keep doing it? That question points to something most people never fully resolve about cash. There's the version you were taught, idle money, inflation bait, the financial equivalent of stuffing bills under a mattress. And then there's the version that serious investors actually use, where cash isn't dead weight at all. It's the asset that makes every other asset accessible at the right moment. My name is Alex, and if you've ever looked at your bank account and felt genuinely unsure whether the cash sitting there was too much or not enough, stay with me, because that uncertainty usually isn't a math problem. It's a framework problem. And once you have the right framework, the answer becomes surprisingly clear. Today, we're going to break down exactly how cash functions as a strategic tool at three completely different levels, why the standard advice skips the most powerful one entirely, and how the real opportunity cost of holding cash is almost always being calculated wrong. And it starts with a framework that most people have never been handed. So here's where the rifle metaphor gets interesting. Because calling cash ammunition is a nice image, but it doesn't tell you how much to load or what you're actually shooting at. And that distinction matters more than most people realize. Here's the thing about cash. It isn't one thing. It's three completely different tools that happen to look identical in your bank account. Same dollars, completely different jobs. And if you treat all of it the same way, just one undifferentiated pile sitting in a savings account, you will almost certainly misuse it. You'll either hold too little, panic at the wrong moment, or miss the window entirely when the right opportunity shows up. The framework that actually works breaks cash into three levels: survival, stability, and offense. Each one operates on a different time horizon. Each one solves a different problem. And here's what I find genuinely interesting about this. Almost every personal finance conversation you've ever had stops at level 1, the emergency fund talk. 3 months, 6 months, done, move on. But that's roughly like loading one round into a rifle and calling yourself prepared. It's a start. It is nowhere near the full picture. Think about where most financial advice comes from. It comes from people who are paid to keep your money moving: brokers, fund managers, advisors on commission. The incentive structure of the entire industry points in one direction: deployment. Get the money working. Every dollar sitting in cash is a dollar not being managed, not generating a fee, not justifying the relationship. So of course the default advice is to minimize cash. That's not cynicism. That's just following where the money flows. Which is exactly why understanding these three levels is worth your time. Because the people who actually use cash as a strategic weapon, not just as a placeholder until the next investment, they don't think about it as one pile. They think about it as three separate accounts with three separate purposes, even if they're technically sitting in the same place. Level 1 is survival cash. This is your emergency fund. 3 to 6 months of core living expenses, liquid, accessible, non-negotiable. The average American household spent roughly $5,800 a month in 2025. So 3 months is about $17,400. 6 months is roughly $35,000. That number sounds big until you price out what a transmission replacement, an ER visit without full insurance coverage, or 2 months of unemployment actually costs. This layer isn't exciting. It's not supposed to be. It exists so that one bad event doesn't force you to sell something at exactly the wrong time. Level 2 is stability cash. This is where the real conversation starts, and it's the layer that almost nobody talks about seriously. 12 to 24 months of living expenses, held deliberately, not because you're scared of markets, but because of what it quietly gives you: options, leverage, the ability to say no. And level 3 is offensive cash. This is capital you are consciously keeping out of the market, not because you don't understand compounding, because you do. You understand it well enough to know that the single most powerful compounding event in financial history happened during crashes, and you want to be the person with dry powder when that window opens, not the person being forced to close positions to pay rent. Now, most people only ever get to level 1. Some get to level 2 by accident. Almost nobody builds level 3 on purpose. And that gap is exactly where the real story lives. Level 1 sounds almost too simple. 3 to 6 months of expenses, set it aside, don't touch it. And honestly, that simplicity is the point. But simple doesn't mean easy, and it definitely doesn't mean obvious. Because a surprising number of people who consider themselves financially responsible are walking around without this layer fully funded. A 2026 Federal Reserve survey found that roughly 4 in 10 American adults would struggle to cover an unexpected expense of $1,000 without borrowing or selling something. Not 4 in 10 broke people. 4 in 10 adults. People with jobs, with 401ks, with houses. People who, on paper, look like they have their financial act together. The gap between looking stable and actually being stable is wider than most people want to admit. So what exactly goes into this number? Your survival cash target isn't your income times 3. It's your actual monthly expenses times 3 to 6. There's a difference. If you earn $9,000 a month, but your real baseline costs, rent or mortgage, groceries, utilities, insurance, minimum debt payments, run about $4,600 a month, then your survival cash target is somewhere between $13,800 and $27,600. Not a round number. Not a guess. An actual calculation based on what your life costs to run at its most stripped-down level. And stripped down is the right frame here. This isn't your comfortable monthly spending. It's your minimum viable budget. The number that keeps the lights on, keeps the car running, and keeps you fed if everything else stopped tomorrow. That number is almost always lower than people expect, which is actually good news. It means the target is more reachable than it feels. Now here's where I want to push back slightly on how this layer is usually described. The standard advice frames the emergency fund as pure insurance, money you hope to never use, a boring but necessary line item. And fine, that framing isn't wrong, but it undersells what this layer is actually doing for you psychologically. Because when this cash exists, when it's funded and sitting there, something shifts in how you make decisions. You stop making choices from fear. You stop calculating whether you can afford to have a bad month. A car repair goes from a financial crisis to an inconvenience. A medical bill becomes something you handle, not something that follows you for 3 years on a payment plan. That shift is real. It changes your relationship with risk in every other part of your financial life. There's a version of this that plays out constantly in the data. When people don't have survival cash, they use credit cards as their emergency fund. The average credit card interest rate in early 2026 sits around 22%, so a $3,000 car repair that goes on a card and gets paid off over 12 months doesn't cost $3,000. It costs closer to $3,360 by the time the interest clears. Do that 3 or 4 times over a few years, and you've quietly paid for an entire extra emergency out of pocket, just in interest. The absence of this cash layer isn't neutral. It has a real calculable price. That's what makes level 1 non-negotiable. It's not a wealth-building tool. It's the floor. Without it, every other financial decision you make gets slightly distorted by the low-grade anxiety of knowing you're one bad week away from debt. With it, you get to think clearly, and clear thinking is where everything else starts. But this is still just the foundation. Level 2 is where the real power lives. Here's a question worth sitting with for a second. What's the actual difference between being trapped and being free? In financial terms, because it's not always about how much money you have. Sometimes it's entirely about how liquid that money is. This is the part that most financial advice just completely skips over. 12 to 24 months of living expenses, held in accessible cash, on top of your emergency fund, not instead of investing, not instead of your retirement contributions, on top of them. And the reason this layer gets ignored is that it's genuinely hard to defend with a spreadsheet. You can't easily quantify walkaway power. You can't put a number on the cost of staying somewhere you shouldn't be. But let me try anyway. The median household income in the United States in 2026 sits around $78,000 a year, which works out to roughly $6,500 a month before taxes. If your actual take-home is closer to $4,800 a month after taxes and deductions, then 12 months of stability cash is about $57,600. 24 months is $115,200. That's real money, held in cash. Earning maybe 4.5% in a high-yield savings account right now, but definitely not in the market. And yes, that will make some people uncomfortable. Here's why it's worth it anyway. This layer isn't insurance against disaster. Level 1 handles that. This layer is about something more subtle and more powerful. It's about the decisions you get to make when you're not operating from desperation. The job you can afford to leave, the lowball offer you can afford to reject, the negotiation you can afford to walk away from. These are not small things. Over a working lifetime, the compounding effect of making decisions from strength instead of fear is enormous and almost completely invisible in conventional financial planning. Let me give you a concrete example of how this plays out. Think about a software engineer in his mid-30s, earning about $112,000 a year, fully invested, maximizing his 401k, that's his employer retirement account, putting money into index funds every month. On paper, he's doing everything right. His net worth is climbing, his retirement projections look solid, but his cash on hand is thin. Maybe 2 months of expenses liquid, everything else deployed. His company starts laying people off. The culture shifts. A new manager comes in who clearly doesn't value his work. He knows he should start looking, but here's the problem. He can't afford a long search. He can't afford to be selective. He can't afford to turn down a mediocre offer while he waits for a better one. So he takes the next thing that comes along, a lateral move. Similar pay, similar dysfunction, because the math of his situation gave him no other real option. Now run the same scenario with 18 months of stability cash sitting in a high-yield account. Same person, same layoff threat, completely different posture. He takes his time. He talks to the right people. He turns down 2 offers that aren't quite right. 3 months later, he lands a role at $148,000. That $36,000 raise, compounded over the next 15 years of his career, isn't a small thing. That's potentially the single highest return financial decision he makes all year, and it was funded entirely by cash that his spreadsheet said was sitting idle. That's walkaway power. That's what stability cash actually buys. Not safety, agency, and once you understand that, the Buffett level starts to make a lot more sense. There's a pattern that shows up in almost every major market crash in modern history. The people who came out ahead weren't the ones who predicted the crash. They weren't smarter. They weren't better at reading charts. They just had cash when nobody else did. That's it. That's the whole edge. This is the Buffett level, and it works differently from the first 2 layers in one critical way. Survival cash and stability cash are both defensive. They protect what you have. They protect your options. Offensive cash is different. It's capital you are deliberately keeping out of the market, not because you're afraid of losing it, but because you're waiting for the moment when deploying it will be worth more than any return you could have earned in the meantime. That sounds straightforward. In practice, it is one of the hardest things in investing to actually do. Because holding cash while markets are climbing feels like losing. Every month the S&P 500 goes up, and your offensive cash pile sits in a high-yield account earning 4 or 5%. There's a voice in your head that starts doing math. You're leaving money on the table. You're being too cautious. Everyone else is in, and you're standing on the sidelines. That feeling is real, and it is exactly the mechanism that keeps most people from ever building this layer at all. Here's what that voice doesn't account for. Crises don't announce themselves. They arrive fast, they hit hard, and the window to buy at genuine panic prices is almost always shorter than people expect. When the S&P 500 dropped roughly 34% in about 5 weeks in early 2020, the full recovery took less than 6 months. The opportunity was real, but it required 2 things simultaneously. You needed to have cash already set aside before the drop, and you needed the psychological stability to deploy it while everyone around you was convinced the world was ending. Most people had neither. Now zoom out a little further. Look at late 2022, when the combination of aggressive Federal Reserve rate hikes and inflation fears pushed the S&P 500 down about 19% for the year. High-quality tech stocks that had traded at inflated valuations dropped 40, 50, 60% from their peaks. Some of them were genuinely good businesses temporarily priced as if they were in permanent decline. The investors who captured those discounts weren't geniuses. They were prepared. They had dry powder, and they used it. Here's the mechanism that makes this work, and it's worth understanding clearly. When markets fall hard and fast, forced selling starts. Margin calls go out. Leveraged investors have to liquidate positions they don't want to sell to cover what they owe. Institutions rebalance. Retail investors panic. What that creates for the person holding cash is a supply of assets being sold, not because they're worth less in any fundamental sense, but because the seller has no choice. Your patience becomes their urgency. Their urgency becomes your discount. Warren Buffett's Berkshire Hathaway was holding around $167 billion in cash and short-term treasury bills by late 2024. Not because Buffett couldn't find anything to buy, because he was waiting for the price to be right. He has said publicly in various forms over the decades that he thinks of cash as a call option with no expiration date. You pay a small carrying cost to hold it. In return, you get the right to act decisively at any moment, on any opportunity, for any amount. No loan application, no selling something else first, just the ability to move. That's the real return on offensive cash, not 4% in a savings account. The option value of being able to say yes when everyone else is being forced to say no. And understanding that option value is what makes the inflation objection a lot less convincing than it sounds. The inflation argument against cash is real. Let's not pretend it isn't. If you're holding cash and inflation is running at 3%, you are losing purchasing power every single year. That's a genuine cost. But here's where the argument usually goes wrong. It treats opportunity cost as a single number, the return you're missing in the market, when the actual calculation is much more complicated than that. Opportunity cost isn't just what you earn, it's also what you avoid losing, and it's what you gain access to that you couldn't have reached any other way. Let me show you how this plays out with a number that most people find surprising. Research from the National Bureau of Economic Research found that all cash home buyers pay, on average, 11% less for the exact same property as buyers who need a mortgage. 11%. On a $400,000 home, that's a $44,000 discount, not because the cash buyer negotiated brilliantly, because cash closes fast, cash closes certain, and sellers know it. A financed offer can fall through at the last minute. A cash offer almost never does. That certainty has a price, and the seller absorbs it. Now think about what that means in real terms. If you held 2 years of offensive cash, earning 4.5% in a high-yield account during that period, you gave up maybe 9% in nominal returns, compared to the S&P 500 in a flat to moderate year. But you walked into a transaction and extracted $44,000 in discount on a single deal. The math doesn't favor the fully invested portfolio. It favors the person who showed up with ammunition. And that's just one category of transaction. The same dynamic plays out in private business deals, in distressed asset sales, in real estate auctions, in any situation where the seller is under pressure and the buyer has certainty. Cash doesn't just save you money. At the right moment, it makes you a completely different class of buyer. But here's the hidden cost that almost nobody talks about clearly. The real danger of being fully invested isn't missing out on gains during normal times. It's what happens when you need liquidity during a downturn, and you don't have any. Run this scenario. A market correction hits. Your portfolio drops 30%. At the same time, something in your life requires $40,000. Maybe a job loss, a medical situation, or a necessary home repair you can't defer. If you have no cash reserves, you have one option. Sell investments at the worst possible moment. Lock in the loss permanently, and miss the recovery entirely. That $40,000 withdrawal from a portfolio that's down 30% doesn't just cost you $40,000 today. It costs you what those shares would have been worth when the market recovered. Depending on the timeline, that gap could be $80,000, $100,000, or more. That's not a theoretical risk. That's the financial reality of millions of households that went into 2020 fully invested with thin cash buffers. They sold near the bottom. They missed one of the fastest recoveries in market history, not because they made a bad prediction, because they had no other option. The person with cash reserves doesn't face that choice. The crisis doesn't become a forced liquidation event. It stays a manageable disruption, and in the best case, it becomes a buying window. So when someone tells you cash is a drag on your returns, they're calculating one side of the ledger, the cost of holding. What they're leaving out is the cost of not holding. Those two numbers are not symmetrical, and in the wrong moment, the second one is significantly larger. That's the actual math. And once you see it that way, the question shifts from how much cash am I losing to how much cash do I actually need. Knowing something and actually doing something about it are two completely different problems. And this is the part where most financial content quietly falls apart. The framework makes sense, the logic is sound, but then the video ends and nothing changes, because the gap between understanding an idea and implementing it in your actual financial life never gets bridged. So let's bridge it. The first move is the most important one, and it costs you nothing to do today. Separate your cash mentally, even before you separate it physically. Right now, if you have money sitting in a single savings account, your brain treats it as one pool. Some of it is survival cash. Some of it might be stability cash. Some of it might be the beginning of an offensive position. But because it's all in one place, it all feels the same, and it all gets spent the same way. The account balance goes up, and you feel fine. It goes down, and you feel anxious. You're reacting to a number instead of managing a strategy. The fix is simple. Create distinct buckets. This doesn't require opening 6 new accounts, although some people find that helpful. It requires giving every dollar a specific job and knowing what that job is. Your survival cash is untouchable except for genuine emergencies. Your stability cash is your walkaway fund, your negotiating buffer, your career insurance. Your offensive cash is patient capital, waiting for a specific type of opportunity, not sitting there because you haven't gotten around to investing it. When those 3 piles have names and purposes, you stop making the most common cash management mistake, which is treating your stability fund like a spending account and treating your offensive fund like guilt. The money stops feeling like a problem to solve and starts feeling like a tool with a specific function. The second move is recalculating what opportunity cost actually means for your situation. This is worth spending real time on. The standard framing is straightforward. Cash earns roughly 4 to 4.5% in a high-yield savings account right now. The S&P 500 has historically returned around 10% annually before inflation, so holding cash costs you roughly 5 to 6% a year in foregone returns. That math is real, but it's incomplete. What it leaves out is the option value we talked about, the 11% discount on a cash real estate purchase, the career leverage of 18 months of stability cash, the ability to buy quality assets at 30% discounts during a correction instead of being forced to sell into one. These aren't hypothetical benefits. They're calculable. And when you actually run the numbers on even one of those scenarios, the cost of holding cash starts to look a lot more like the price of admission to a different class of financial decision-making. The third move is the one people find most uncomfortable, but it might be the most important. Audit where your financial advice is coming from and understand how that person gets paid. A fee-only financial advisor charges you directly for their time and guidance. Their recommendation to hold more cash costs them nothing. A commission-based advisor or an assets under management advisor earns more money when more of your money is deployed in products they manage. That's not a conspiracy. That's just an incentive structure. And incentive structures shape advice in ways that are often invisible to the person receiving it. In 2026, the average assets under management fee sits around 1% annually. On a $500,000 portfolio, that's $5,000 a year. Every dollar you hold in cash instead of in their managed portfolio is a dollar that the fee doesn't apply to. That's worth knowing when someone tells you that cash is a drag on your returns. None of this means financial advisors are bad or that you shouldn't use one. It means you should understand the model before you take the advice. Follow the incentives. They'll tell you more than the pitch ever will. Here's what this all comes down to. The financial system is not designed to help you hold cash. It is designed to keep your money moving through products, through managers, through fees. Every piece of conventional wisdom pointing you toward full deployment exists inside that incentive structure. That doesn't make investing wrong. It makes unexamined advice dangerous. The investors who consistently come out ahead aren't the ones who found better stocks. They're the ones who had options when other people had none. Survival cash keeps you solvent. Stability cash keeps you free. Offensive cash turns other people's crises into your opportunities. 3 layers, 3 completely different jobs. So here's what's worth sitting with. Look at your own cash position right now. Not your net worth, not your portfolio. Your liquid, accessible cash. Which layer is actually funded? Which one is missing? Because the real question was never whether cash earns enough. It was whether you had enough cash to make the right move when it mattered.